Hi, everyone. Welcome to the special live edition of the SBS On the Money podcast, where we are taking you through the interest rate decision from the Reserve Bank live as it's handed down. The market has a 70% chance we'll see an interest rate rise from 3.85% to 4.1%. We'll find out in a few moments' time. One of the main reasons for that is because inflation is way above the Reserve Bank's target band at 3.8% annually. The trim mean, which it takes a closer look at because it strips out one-off volatile moves, is at 3.4%. The Reserve wants it to be between 2.3%. So it is above that. And then, of course, we do have that oil price, which is surging, flowing through to higher petrol price. That petrol price, the national average at $2.19.5. According to the Australian Institute of Petroleum, that is a record high. Before the RBA decision, let's quickly check in with Stephanie Youssef. She's standing by to tell us what's happening on the market. Steph, how's it looking?
Well, Ricardo, the ASX is currently up about 16 points. It's pared back since some of the gains made this morning when it opened higher on weak oil prices. But with this decision looming, investors have appeared cautious this afternoon. It's currently about 0.19% higher. Sorry about that. It's currently 0.19% higher. Meanwhile, let's take a look at the Australian dollar, which remains at a near 3-year high. It's currently trading at about 70.82 US cents. So, Ricardo, not much movement at the moment. Let's keep an eye on that decision.
Okay, Stephanie Youssef, thanks for that. We'll check in on you later on to see how the markets have reacted to the decision. We are still waiting for that decision from the Reserve Bank. It should be dropping any time. There you go. You are seeing on screen what I'm seeing, and the Reserve Bank has decided to lift interest rates by 25 basis points. So this is a decision coming from the Reserve Bank board. It's a statement that it releases on its website for us all to see, and you're seeing it as I'm seeing it. So the Reserve Bank did decide to lift interest rates by 25 basis points to 4.1%. It says while inflation has fallen substantially since its peak in 2022, it has picked up materially in the second half of 2025. It says the conflict in the Middle East has resulted in sharply higher fuel prices, as I mentioned earlier, which, if sustained, will add to inflation. So it's keeping a close eye on that higher fuel price and those oil prices. It adds that short-term measures of inflation expectations have already risen. So when we expect inflation to rise, consumers start acting that way, and it means inflation could stay higher for longer. So that is a key issue. It's talking about higher capacity pressures, reflecting in part the greater momentum in demand in the later part of 2025. There are all those other issues that the RBA is mentioning. I'm going to go to the bottom part of the statement where it talks about the decision and why it's done it. Again, it's talking about inflationary pressures picking up materially in the second half of 2025. The board assessed various scenarios. Let's have a look here. So the board will be attentive to the data and the evolving assessment of the outlook on and risks to guide its decision. So it's, in other words, it's keeping a close eye on what's happening in the economy. In doing so, it'll pay close attention to developments in the global economy and financial markets, trend in domestic demand, and the outlook for inflation and the labour market. That's the other key thing too. Australia's unemployment rate is relatively low at 4.1%. Monetary policy is well placed to respond to developments. So what that basically means is that the board is in a good position to go up or down if it needs to respond to the way the economy is moving. And today's policy decision was made by majority. 5 members voted to increase the cash rate target to 25 basis points to 4.1%. So that's a majority. That's not all members of the RBA Monetary Policy Board. So that's just 5 members. Okay, so if you're just joining us, the Reserve Bank has decided to lift official interest rates by 25 basis points to 4.1%. That is the second move this year. Let's check back in with Stephanie Youssef. She's taking a look at how the markets have reacted. Stephanie, how's it looking?
Well, Ricardo, the ASX has jumped slightly. It's up 0.35% at the moment, while the Australian dollar has actually fallen sharply. It's now at 70.61 cents And it's just looking like it's just ticking a little bit back up now. So it's fallen quite sharply in the past few minutes, Ricardo.
Okay, thank you, Stephanie. So that's the market's reaction, both the equity market and currency market. What does it mean for your mortgage? Okay, so that 25 basis point increase on a $500,000 25-year owner-occupier mortgage will mean a $76 per month increase in your monthly repayments. But if you consider that the Reserve Bank lifted interest rates twice this year, that March increase we're about to see, plus the February increase, that means on that $500,000 mortgage, your repayment will rise by $151 over the past 2 months. So for a $700,000 mortgage, it's a $106 per month increase once the banks pass on this rate rise to borrowers. But if you factor in the previous increase, that means $211. For more, I spoke earlier with Sally Tyndall. She's the research director at Canstar to find out what it means for your mortgage and for savers.
This is yet another blow for households across the country with a mortgage and potentially renters as well. It's not just a double whammy, having a hike in February and now again in March, because families are already battling higher petrol prices, the end of the electricity rebates, yet another rise to private health insurance premiums. It is all starting to pile up on already stretched households.
This will no doubt, as you mentioned, be troublesome for borrowers and may prompt some borrowers to review their rates. How do they know if they're on a good rate? What is a good interest rate on a home loan?
Well, this rate hike, we expect the banks all to pass it on in full. This should prompt borrowers to check their interest rate and understand exactly what a good rate looks like. Right now, after this rate hike filters through, we expect that the average owner-occupier is going to be on a variable rate of 6.01%. We haven't seen the average owner-occupier variable rate sitting in the sixes since April of last year, but we're back here yet again. But you should be on the lower end of that average, definitely in the fives as an owner-occupier, and a good stretch target at this point we expect to be under 5.75%. In fact, Canstar analysis shows that if banks pass it on in full, there'll still be over 40 different lenders offering at least one variable rate under 5.75 once this rate hike filters through. In fact, there could be a handful of lenders still offering variable rates around that 5.5 mark, but it's a matter of shopping around, understanding whether your rate is competitive, and if you find it's not keeping up with the pack in terms of the competition, it's time to get on the phone and ask for a rate review from your current bank or refinance to a different bank willing to offer you a more competitive deal.
Given this talk of further rate rises, how should a borrower approach the whole should I fix or stay variable decision? What do they need to know?
Well, for starters tonight, sit down and understand exactly what the impact of this rate hike will be on your minimum monthly mortgage repayments, but also do the math on another hike, because we've got all four big bank economic teams predicting that there could be still more rate paying to come in the months ahead. Whether to go fixed or variable, I know a lot of borrowers will be contemplating that at this point in time. They just want to mitigate that rate hike pain that we've been having in February and now again in March. But it's important to understand the fine print when it comes to fixed rates. Firstly, there's typically a cap on extra payments in the fixed rate term, but also most fixed rates don't come with features like an offset account. So factor that in, but also understand that the RBA is currently in a hiking cycle. But that doesn't mean they could just suddenly do a U-turn back to cutting the cash rate, particularly if the war drags on and these, the impact of rising petrol prices starts having a very negative impact on our economy. People start laying off jobs. That's when the RBA could well step in and issue a number of rate cuts in order to revive the economy and boost jobs. And so that could be not too far in the distant future. You really want to be factoring in the possibility of rate cuts instead of hikes in your fixed rate maths.
Okay, and we've spoken about borrowers. What will this mean for savers, and what kind of savings rates are out there?
Well, as we know, unfortunately, all too well, banks play a game of chicken when it comes to announcing their savings rates. They're very quick to announce that they're passing on the rate hikes to variable borrowers in full. But with savers, they hold back on those announcements and then start to pick and choose which savings rates get a boost and which miss out. And in some cases, within the one savings account, banks could boost, say, the bonus rate, but not apply it to the base rate. So if you've got money in the bank, keep a keen eye on exactly what your interest rate is, not just that headline figure, but also the base figure, and make sure that your bank is passing it on in full. A good rate after this rate hike filters through will be sitting at around 5%. We expect a number of banks will be sitting there in the 5% club, offering at least one ongoing savings rate at that 5% mark. If someone's looking for no terms and conditions, you're probably going to have to accept a little bit less, something around the 4.75% rate mark would be good for an ongoing savings rate without any of those strings attached.
Okay, that's Sally Tyndall there from CanStar running through what this 25 basis point increase in official interest rates will mean to consumers once the big banks pass them on to their customers. As of right now, we haven't heard from any other banks except Macquarie Bank, which was gutsy enough to say we are currently reviewing the RBA's decision to change the official cash rate and what this means for its customers. Stay tuned. We'll update on our website with the latest information. So that's the only bank we've really heard from of the majors anyway. More recently, it's taken the banks maybe 2-3 hours. So we'll wait to see what happens there. But let's check in on the share market one final time to see how investors are reacting, both on the equity market and currencies. For that, Stephanie Youssef is joining me. How's it looking?
Well, Ricardo, it's been about 10 minutes since that decision was handed down. The ASX is still higher. It's about 0.16% up at the moment. The sectors are mixed, with rate-sensitive consumer discretionary and tech stocks leading the losses. Meanwhile, the Australian dollar, it's still trading at a near 3 record high, but it did fall. It did fall after the decision was made. It's currently at 70.6 US cents. So, Ricardo, we'll just have to keep an eye on how the day continues to unfold.
Yeah, thanks for that, Stephanie. That's Stephanie Youssef there updating us on the market and currency reaction by this decision from the Reserve Bank to lift interest rates by 25 basis points to 4.1%. We'll have full analysis on the SBS On The Money podcast tonight, along with the SBS World News Bulletin at 6:30. We'll be speaking with the Chief Economist of Bank of America, Nick Stenner, along with Alice Shen from Van Eck for the market reaction. What's interesting out of this statement from a very quick look initially is that it was a majority decision. 5 board members agreed to lift rates, but 4 didn't. We'll ask whether or not that had any major influence. So stick around, listen to the SBS On The Money podcast. That's coming up tonight on Apple Podcasts, Spotify, wherever you stream your podcasts from. And I'll see you then later. This SBS On The Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.